We do trade again. We market make to all the clients who trade with us. So therefore, by definition, we're taking the other side of the client's position as they put the trade on. On something like the equity book, we run a very, very tight ship because we have 4,000 products we're offering on the platform, 4,000 equities we're offering on the platform. We don't have enough people on the desk to be running those positions in all those markets. So we run a very tight book on the equities, and we hedge pretty much back to back most of the trades that are done, not necessarily specifically as the trade is done in the market, but as we build a position in it. So we also, obviously, because we're giving you the gearing to trade £1,000 worth of Vodafone for just £100 down, we are in effect lending you the £999 to trade that size of stock. What we charge you is an overnight rolling fee of a base rate plus 2.5%, which covers the cost of borrowing that money. Whilst base rates are obviously down at 0%, that's obviously very cheap to run a position. Base rates back up at 10%. You have to factor that into the cost of dealing. Certainly, while they're at 0%, it's quite cheap at the time to be gearing yourself up to trade shares. Yeah, so the interest is charged on the notional size of the position. So although you've only traded £10 a point of Vodafone, we work out the notional size of that equivalent of 1,000 shares, £2 a point, £2,000 worth of notional Vodafone, and charge the rolling fee on that. So again, with interest rates down at virtually 0%, you get charged as a sort of administrative fee the other way around. So we charge plus or minus 2.5% whether you're long or short. If you're short, we would pay you the interest rate minus 2.5%, which becomes a sort of a double negative. Interest rates at 0.5%, 2.5%, we charge you 2%. It's part of the administrative fees of trading shares. Interest rates back at 10%, you'd receive an interest payment for shorting shares.